football, the red zone is where a team has to make small adjustments to ensure victory. As you approach retirement, you also need to make small adjustments to ensure success. This is the Red Zone Retirement Program with registered investment advisor and enrolled agent John Mears of Mears Money Management.
Welcome back in for another edition of Red Zone Retirement Program, Simple Investing, Smart Future with Coach John Mears and myself. And Coach, we're going to talk about one of the two relatives that we have that constantly has their hand in our pocket. It's usually Uncle Sam and Aunt Irma is something I was taught to remember it by. Irma is what we're going to talk about today. It sounds like a person's name, but we're going to dive into the IRMAA Medicare hidden penalty a little bit. How you doing this week? You doing all right?
Doing well. As we're recording this, we're getting into football season, so too bad for your Lions. But
hey, shots fired.
Easy.
So rude.
So yeah, and out here, there's still it's kind of funny. There's still a lot of Raider fans, even though the Raiders have been long gone for years here in Southern California.
Yeah.
So I got the crazy Raider fans.
Well, so what? So what are you rolling? You rolling Rams? Are you rolling Niners? What are you doing?
I still don't. I kind of lean Niners for pro football. I don't really have a pro football team these days, but I guess I lean towards the Niners because that's where family and friends are. So
gotcha. Well, the Lions have been bad for like 1,000 years. So when they do it well, occasionally it's short lived.
All good.
But hopefully we'll see. But anyway, well, let's get into IRMAA a little bit. What is it? Why does it exist?
First of all, it is a penalty for making too much money, if you will. That's what it is.
Yay, government.
So it's an income related. I have my notes here somewhere. Income related monthly adjustment amount. What it means basically is Congress, I think, passed this 25, maybe 30 years ago or so. And it's to basically, make it means adjusted for your Medicare premiums.
Yeah, it's based on your modified adjusted gross income, right?
Yes.
Your Maggie.
If the more money you make, they're going to charge you more for your Medicare Part B. Medicare Part B and Medicare Part D. I'm kind of stumbling here. Those are things that we actually pay for. We don't pay for Part A.
Right,
so Part B and Part D we pay for, and if you're making too much money, they're gonna penalize you. Now, what's interesting about this is they don't know what you made right now. They don't know. So this is backwards looking. It goes back 2 years. So for 2025, it goes back to your 2023 tax return.
Yeah.
So it looks at that, sees how much money you made. If you made too much money, then they penalize you a little bit. So the thresholds are different for marrieds and single people.
I'm going to jump in here on you. The marrieds, I like that. We got to roll with the marrieds. The marrieds and single. We got a graphic for folks to check out to kind of help illustrate these adjustments a little bit.
Yeah, so if you make over $200,000, which can happen, and we're going to talk about what might trigger that. If you make over $200,000, they're going to start penalizing you. So if you can see from the graphic, if you make more than $200,000, you get penalized at $74 a month for Part B. About $14 a month for Part D. So that's almost $90 a month. Over the course of a year, that's another, we'll just round up. We'll call it about $1,200 per year. And again, the more you make, the larger the penalties will be to a max of $450. And we'll call it about $550. That would be thousands of dollars per year. Can add up a lot over the course of the year. And so this is why I tell people, sometimes the actual number isn't what is going to throw you off. I just think people get really annoyed and frustrated, occasionally even angry when these IRMAA surcharges kick in, because the attitude with a lot of people is the government gets you coming and going, but the reason why Congress passed this was to basically, if you are wealthy and you don't need the subsidy as much, they kind of penalize you a little bit for that. There is a sense of fairness for it. Don't know if I completely agree with how they did things, but that is what it is. But a larger issue is, can we as planners avoid this? Is there something that we can do in case this is going to happen?
Well, let's talk about a few things that would trigger it. I mean, basically, to make it kind of easy to think about, it's income, right? So what are some items that would cause your income to go up? That's going to trigger it. Give us a few examples.
There's a lot of things. First of all, if you're at retirement age in 2023, let's say you were working, making some good money. In 2025, you're not working, you're on retirement.
Right.
That alone is one thing that will trigger it. Other things that could trigger it is if you sold something. I had a client that sold a rental property, and that triggered it. Now, that was a one-time event, but that was a large capital gain at the time. There could be just regular RMDs. If you are reaching age 73 or in the future age 75, and your RMDs are going to kick in, that is something that could affect it. Now, this is why we want to plan ahead for RMDs, and there might not be anything you can do with the RMDs either, if that is what it is. But
Right.
those are things that will happen. Any other taxable investment can trigger it, just selling stocks, capital gains, that sort of thing. There's a lot of things. And I'll add one thing that we do as planners, Roth conversions. If your advisor or you are not paying attention when you're doing Roth conversions, it can kick in. So this is why when we're doing Roth conversions, we keep an eye on that.
Yeah, so you're jumping the cart here. So you're jumping the horse over the cart, or whatever that is.
Yes,
we're going to talk about strategies, and that's one of them, right? Yeah.
Yes. So these are things that can trigger it, though. That's why we want to make sure we understand that that can trigger an IRMAA surcharge as well if you're not paying attention.
Can a lump sum pension payout do that as well?
Absolutely. Yes.
Yeah. Okay.
There's lots of things that can trigger it. So again, anytime you have an unusual bump in income, which happens to people sometimes,
right, that
can trigger it. So this is why we have to pay attention to it. And again, these are kind of solid, pretty decent bumps for people. If you're on fixed income, we're trying to manage, your costs going forward. $1,000, $1,500, several $1,000s a year. That matters. That means something.
Yeah.
So we want to keep our eye on it.
So obviously Roth IRA withdrawals, HSAs, that doesn't trigger it because, again, tax free. So that's changing that kind of, that's
So that's something that So reverse mortgages, if you have that doesn't, that again, that's a loan technically. So that doesn't trigger it.
Okay.
Any Roth distributions don't trigger it because those are tax free.
Right.
So those are things that that will not trigger it. So this is why, as far as strategies go, we may do Roth conversions prudently, if you will, prudent Roth conversions, so that we can reduce our RMDs in the future and also make sure that we're not having any more taxable income in the future. So
right. So some of those strategies, that's going to be the big one, John, right? I mean, that's the biggest one. If you're sitting on $1 million or a $2 million 401k and you're heading into retirement, right? A couple of reasons to consider doing Roth conversions is simply the tax bomb that's waiting on you and possibly IRMAA, right? So it's kind of a double whammy there.
Correct. So when we're doing our Roth conversions, we're obviously trying to manage tax brackets when we're doing it, because that's the whole point to a Roth conversion.
Right.
But we're managing tax brackets. We're also trying to go up to the limit, as you saw, what we'll call the 212 for marrieds, 106 for singles. Mm-hmm. We don't want to go beyond that to kick in the IRMAA surcharges, or if we do for whatever reason, we want to at least let the client know this ahead of time, because the devil you know is better than the devil you don't know. So as long as you can kind of tell Mr. and Mrs. Smith, by the way, you are going to pay a little bit more in Medicare premiums for 1 year.
Yeah.
But we saved a lot of money in taxes, if that is the narrative here. Also, something I want to point out is you can actually appeal these as well. If it's a one-time event and things have changed, there's a form SS44 that you can download. It's actually a very easy form. I have one here with me. It's just a couple check boxes, folks. It's really, really easy. You do have to provide proof. You can also call them. They're very, very accommodating on this. I want to make sure you understand this. They're very accommodating. So if there is a one-time event and things have changed, you want to just tell them and explain that to them. They'll understand this. Trust me, they will. You have to have proof. They won't just go by your good looks, but you can tell them, explain that to them. You can walk into any Social Security office. Again, if you have your proof with you, they're very accommodating. They can usually do it on the spot and take care of you. But again, it's a very, very easy form to do. We can help if you need help with it. It's not a problem. We're happy to help in these instances.
So just a couple other strategies. What's some other things to think about? Obviously, you guys can help with the forms, and you can help with all of this stuff. So obviously, we're trying to lower taxable amount, right? So we're trying to lower income. Mm-hmm. So I talked about the Roths. Tax loss harvesting, offsetting some gains.
Tax loss harvesting is one you can do. Again, if your account or any security is down in December, whether it be stocks or mutual funds, you can sell them and take your tax losses and use that for current and future tax gains. One thing I like are QCDs. That's a qualified charitable distribution. This is when you get to the point where you're getting your RMDs. If you have your required minimum distribution and you are charitably inclined,
right,
have some of your IRA funds sent directly to a charity. That doesn't count against your IRA distribution, doesn't count against your income, so it doesn't get thrown into this MAGI, modified adjusted gross income calculation. So QCDs are a great workaround. Again, if you're charitably inclined, this would be a great. I use this with several people. We give them checkbooks, and they write checks to their church and whoever else. It's a very convenient and very easy thing for us to manage for you. But it's a great strategy to kind of get around this stuff. So there's several strategies we can use. mainly to me, it's just being on top of it, being aware and knowing what's going on, so that I'm getting ready to do my fall reviews right now, and we are looking at your taxes right now, and we're going to know with every client we meet whether IRMAA is something we need to be concerned about. I actually have on a little chart that I give my clients every October. Be aware, this is where the IRMAA threshold is. And so again, the devil you know is better than the devil you don't know. You're aware of it. You can manage it then. Or if you do trigger it for whatever reason, at least you know it ahead of time rather than getting a surprise notice from Aunt IRMAA in 2 years.
Yeah, exactly. Well, look, it can sneak up on even well-prepared retirees, to John's point. But, with some planning, some smart planning, you can hopefully reduce and maybe, drop down that surcharge. And again, it's all a taxation kind of thing, right? So, John's got a couple of great books that work well for helping you with some of that. So check this out if you'd like to get a copy. John has a couple of free books, Diffuse and Tax-Free Retirement in California, that reveal exactly how you can experience zero taxes in retirement and overcome the IRS lien on your 401k, IRA, and 403b, which could threaten your future lifestyle. These are complimentary, so all you have to do to pick these up 100% free is just stop by rescuemyretirement.net. That's rescuemyretirement.net. Fill in the basic info and he'll ship those out to you immediately. That's rescuemyretirement.net for a copy of Diffuse and Tax-Free Retirement in California. All right, John. So, at the end of the day, people just got to get on the calendar, have a conversation, because there's all these little things, which is why we do the show. There's all these little things that pop up, right? It's like growing the money is a lot easier than the preservation and distribution stage. And that's really what retirement's all about. It's finagling all those little nuances.
Yeah, I tell people all the time, I'm not sure I can make you rich, but I certainly can keep you from being poor. That is something that we really work on here. And yeah, there's a lot of nuance in retirement. The accumulation phase, not very complicated, really. But the distribution phase is very complicated.
Yeah, I mean, even if you just, did a 401k for 35 years and you just pumped into it or whatever, you're probably in pretty good shape, when you get there, but it's getting through retirement.
How do you get out of it? Yes.
Right.
How do you get that money back into your pocket prudently? Yes.
Yeah, exactly. So if you need some help, go to bookachatwithjohn.net. That's bookachatwithjohn.net. So they're on the screen, but we also have all the links in the show descriptions of the each and every week's podcast. So just click on the link, get some time onto the calendar, let John know you need some help. Let him know you want a copy of those books, whatever you need to do, but take some action for yourself and get started today. And don't forget to subscribe to us on Apple, Spotify, and of course here on YouTube. We've got shorts, we've got the full reels and everything. So check some of that stuff out. A lot of good content. Coach, thanks for hanging out and breaking it down, brother.
Thank you. Appreciate it.
See you next time here on Red Zone Retirement Program, Simple Investing, Smart Future with Coach John Mears.
Advisory services offered through Mears Money Management, Inc., an RIA registered in the states of California and Texas. California Department of Insurance License number 0685203.